Hi and welcome to the channel. Today I'm going to evaluate a subscriber's dividend portfolio that they sent to me. If you also would like your portfolio evaluated, please leave it in the comments and send me an email with your holdings. I have made a spreadsheet to evaluate the risk, the earnings, dividend, valuation and also the diversification. So 5 different means to evaluate a portfolio. And let's get right into it. First off, the first holding is actually Microsoft. Doesn't need a further introduction more than it's a great tech company, both servers, Windows, databases, and office production software. A nice beta of only 0.92, and this means that it's actually less volatile than the index. The index is 1. And the earnings per share are really up there, 24.3%. The dividend not the best at 1.13%. And the PE is quite steep at 26. Next up we have Lockheed Martin, a defense and aerospace giant. A nice contractor for the US government, but they also have other customers around the globe. This actually counts as an industrial sector, and it also has a really nice beta, earnings, dividend, and also quite highly valuated. Next one is BlackRock, the giant of investment banking and financial services. They spiked up quite a lot recently, so their beta is a bit up there at 1.31. Nice earnings, also relatively nice dividend at 2.71%. Next holding is T. Rowe Price Group, quite similar to BlackRock, but they have a bit more dividend and took a larger hit than BlackRock during the last fall off. Johnson & Johnson we have next, healthcare giant, and this is one of the favorites for dividend investors, and we can see why. It has a really low beta, so you can always count on Johnson & Johnson being a pillar in your portfolio, both for their very long dividend streak and solid financials. Then we have Mondelez. It's a consumer defensive snacks and candy company. They have really strong brands like Oreo, Marabou and such. And we can see that it has a low beta, very nice earnings per share, a nice dividend, but the valuation is quite high at almost PE of 29. Then we have Starbucks. We go from consumer defensive to consumer cyclical, and same with Starbucks. They have really picked up lately, and I think maybe the unionization problem and CEO swap is in the past. So otherwise a really nice both growth stock and dividend stock. But same thing here, the valuation is quite steep at a PE of about 34.5. Then we have JP Morgan Chase, big bank in the US, and beta about 1, 20% earnings growth, almost a 3% yield, and a PE at 11.3. Then we have Verizon, communication services giant. I think they have the most mobile phone users, and then AT&T and T-Mobile. But same as for AT&T, Verizon had to buy a lot of 5G licensing, so they have quite a lot of debt. But other than that, the beta is really low and the dividend is extremely high. Then we have Apple, and as for Microsoft, Apple doesn't need any further introduction. It's a really good company, both for their, of course, products and also their financial. The only thing is that the dividend is not that high, only 0.61%. Then we have another healthcare stock, Pfizer, and the beta is low, nice earnings, nice dividend, and also quite affordable. After that, we have another favorite among dividend investors, and that is Realty Income. It's a real estate investment trust, a REIT, and Realty Income is paying dividend monthly. Then after that, we have Walgreens Boots Alliance, another healthcare stock, but this is only 2% weight in the portfolio. A nice beta 0.7 and a really nice dividend yield at 4.83. And the last stock is, let's see if we can get rid of this one, is Rio Tinto Basic Materials sector. This is a mining company. This is only 2% of the portfolio, and we can see that the beta is only 0.65. They had some nice earnings, a really high dividend yield, and only PE of 6. But keep in mind, even if the beta is low, this is a highly cyclical company. So there we have it. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 holdings in this portfolio, which I think is a really good number. Not too few and not too many to manage. But let's also now check how the beta is in total for this portfolio, and here we can see that it's actually below index at 0.86. So with this portfolio, you could go to sleep and not feel that worried about your stocks going up and down like crazy. And then let's take a look at the earnings per share, which is actually an average of 16.5% for the holdings. If we look back 5 years for the S&P, it's about 12%, I believe. So this is also better than index. Good job. After that, we check the dividend, and a really nice average dividend of 3.64%. So this is a dividend portfolio, so of course it's going to have a bit higher dividend than the S&P 500, for example, which is about 1.7% right now. And last we have the PE, which is 21.27. A month or so ago, I think the PE was about 17, 18 for the S&P. Right now, I think it's about 20. So this is actually in line with other stocks. So far, so good. Let's also check the sector diversification to the right. Here we have basic materials, and the dotted line is the S&P 500, and the filled in pillars is actually this portfolio. So for basic materials, we have Rio Tinto, and this is well in line with the S&P 500. After that, we have communication services. It also looks very good. Then we have consumer cyclical, also very similar to the S&P. Then we have consumer defensive. Then we have financial services, and here we can see that we are actually about 29% deep in financial services, so might be good to ease off a bit about this sector. Then we have healthcare, looks good, 14% of the portfolio. Industrial, 11%, also balanced. Then real estate, 3%, very balanced also. And then technology, 15%. And right now tech is about 24% of the S&P, so I think we could look at some more tech in this portfolio. Then we have energy, and there are no energy stocks in this portfolio, and same goes for utilities, which there are none. But all in all, I think this looks extremely good, especially for not having that many stocks. It's not like there is 40-50 stocks in this portfolio, and all the metrics looks very fine, and there is a good mix of companies and sectors, and the beta, earnings, dividend, and the PE looks all good to me, so very well put together. If you found this informational, please hit the like button, and also you can submit your portfolio for me to evaluate. See you soon.